Hello, everyone. Good evening to you all. Welcome to a very special episode of Webcast today. Today, we have a special guest, Nilesh Shah, who is the CEO of Kotak Mutual Fund. Nilesh, very welcome, warm welcome to you. Nilesh, can you hear me? Hi, Nilesh, can you hear me? Nilesh, are you able to hear me?
Yes, now I can hear you.
Okay, thank you so much. Sorry for the minor glitch. I just said a very warm welcome to you to our show, Wealthcast. Let me set a context for the conversation. Today the BSE Sensex ended at 46,800, which is among its highs. Everyone has a question in their mind. Market kya bolta hai? So I want to start with this question. 2 years ago, you had described the markets in a very, very nice manner. I want to take you back to that. So the markets were in the narrow range of 25 to 30,000. So you had described the market as a Mughal-e-Azam market, where FII inflows were pulling up the market, and domestic pressures like inflation were keeping the markets lower. And that was a beautiful analogy where it kind of summed up what is happening to the markets. So now, as we look at December 2020 with market being, Sensex being like 90% higher than pre-COVID levels, or even 10% more than the previous lifetime high, how should we describe the market? Should we call it Uttar Punjab? What's your view?
So I'm filmy buff, but I'm more like the mid 80s and 90s films. So I will call this as a Amar Akbar Anthony market. That was Manmohan Desai's fantastic film. And there was a song which said that Honi ko anhoni kar de, anhoni ko honi. जब एक जगह पे जमा हो तीनों, Amar Akbar Anthony. So our market has seen a record high and quite unexpected all kind of thing. And this has happened because three things have come together. Fund flow, money is pouring in, fundamentals, businesses are improving, and sentiment which has turned bullish. So with fund flow, fundamentals, and sentiment coming together, like Amar Akbar Anthony, they are creating this unhoni.
No, understood. That's a great analogy from the 1970s. So I think fund flows are, particularly from the foreign institutional investors, they're coming in droves, Nilesh. But last 2-3 month data suggests that the domestic institutional investors, particularly around mutual funds, etc., we are seeing kind of outflow from domestic markets. We are seeing higher redemption. So how do you read this? Where for the past 3 months, outflow from domestic markets, particularly even retail profit booking type of a thing, and institutional investors, foreign institutional investors coming in. How do you read these two conflicting signals?
So one in the month of March, when FPI sold 60,000, domestic institutional investors bought close to 50,000. Now that has multiplied in a very short period of time to almost 1 lakh crore. It's not exactly 1 lakh crore, but almost. Now that has pushed people to do the profit booking. So if you see mutual fund flows, retail SIPs have continued. HNIs have done profit booking because they were not anticipating this kind of rally. And institutional investors like pension funds, they have also put redemptions because of profit booking. So we have now three distinct segments: retail investors buying, HNI selling, and pension investors, institutional investors selling.
Understood. So you're saying basically the domestic outflow that we are seeing is largely driven by HNI customers. But at the same time, Nilesh, we are also seeing, from the HNI segment as well, significant demand for IPOs. Like one of the IPOs that got closed today, the HNI segment got subscribed like 500 times or something like that, some very, very high number, some 50,000 crore bids. And we've seen some of the earlier IPOs as well, the Burger King IPO and the earlier IPOs have also attracted significant HNI interest in the IPO segment, IPO. So are you seeing some sort of any sort of such behavior where people are thinking IPOs are a better place to put money than mutual funds? How should we read multiple signals?
So there is a feeling of left out among some set of investors. They never anticipated that markets will rise so much. And after sitting on cash for bulk of this rally, they are jumping at whatever opportunity comes in. And that is best manifested in IPOs. You can apply in IPO by borrowing money from NBFCs, and which is where HNI application goes hundreds of times of issue size. And then depending upon gray market premium, you can take a call. Now, my recommendation on IPO to investors is that, look, you have choice of investing in a good company, but everything is good at a price. So in IPO, please make investments. It's a fantastic opportunity. But if they have run up too sharply, then you need to be circumspect about it. Promoters are not going to sell their company cheap. They know what is their value. If promoter is offering his company at 100, hoping that you will make 10-20% return, it's perfectly fine. But if that stock is up 300% in a day and you are buying at 400, then you have to ask a question to yourself, am I so much smarter than the promoter who sold this company just few days ago at 100 and I am buying it at 400? So don't jump into IPO market because every IPO is getting listed at a premium. Evaluate it on fundamentals and then invest.
Understood. Totally makes sense. Going back to your filmy analogy, Nilesh, Amar, Akbar, Anthony, I want to speak about each of those aspects. I'm assuming the first one, which is the foreign institutional inflows, is driven by the second one, which is improving economic indicators, right? So, is there more to why foreign inflows are coming so much? Or is it just the domestic indicators expected to improve in the next few months? How do you read such a large inflow of capital into the country?
So I think a lot of things have come together for India to achieve this. One, on 5th of November, Prime Minister spoke with investors and he gave a message about growth with green returns. Now, he talked about ESG investment. Now, this is something which no other prime minister would have spoken. And from that day onwards, we are seeing on a daily basis FPI virtually buying what they used to buy in a month earlier. So I think prime minister's talk with investors acted as a catalyst. Second, obviously, is our month-on-month improving fundamentals. We saw record sales by automobile companies. We saw record profitability by companies. So that also excited for portfolio managers. The third bigger thing is, I think, the way India is perceived. अपने वहां पे कहावत है कि जो बचाता है उसकी कीमत मारने वाले से ज्यादा है. Now look at the world. China gave them Wuhan virus. India first supplied hydroxychloroquine tablet and now is in a position to supply vaccine. Now this has changed perception of India. Many people thought India was substantially behind China. It's a country not worth investing. And now they are suddenly shocked that, oh, this is the country which is going to save the world. We must reciprocate. So we are seeing multiple factors coming together, which is convincing this foreign portfolio investors to invest in India. And which is why we have never seen this kind of flows. November was highest ever monthly FPI flow at $8 billion. My feeling is that this run rate will continue in 2021 as well.
That's interesting to hear the speech and the ESG impact, Nilesh. So the second part, which is the improving economic condition, right? Now, when we look at our average retail investor, right, he or she is looking at two very, very divergent set of metrics. One is the index numbers, Sensex numbers. The other one is, GDP data. Although GDP data comes with a 2 month lag for a particular quarter, it's a very, very specific data. So from an average investor's perspective, it's very confusing. On one hand, we're seeing like a -8%, -10% growth, or a negative growth in GDP. On the other hand, we are seeing, markets reaching lifetime highs. Obviously, there are lots of other metrics that go into saying, hey, listen, this is the economy is improving. So I would request you to talk about, 3, 4, 5 those metrics that fall into the second bucket, which is the economy is improving. Because the reader, when he reads Times of India, he or she is seeing, hey, -8%.
Yeah. So data is like rear view mirror. It gives you data about last 3 months, last 6 months, last 1 year. And market is like a periscope. It only looks at the front. Now periscope can move 360-degree, but just for a second, give me the liberty that it goes outside current water and tries to see what is there in the front, which is why data will always be positive or negative, and market's future could be completely different. Now we are at that stage where past data will look bad, but the future will look bright. That is because month on month things are improving. July was bad, August was better than July, September was better than August, October was better than September, and the trend has continued. So our fundamentals are improving slowly and steadily. More importantly, there are some game changers which are happening. For example, this 1980, India and China were of similar size. They became manufacturer to the world. We were left out. Now we are getting companies to move out of China to India. A German footwear company shifted its entire footwear manufacturing to Agra. Samsung first shifted its entire mobile handsets plants from China to Noida. Now it is shifting color picture tubes from China to India. Slowly and steadily, this is becoming a trend where more and more companies wants to come to India to set up their base. The government of India came out with PLI scheme. Now, if you remember, earlier we had something called textile upgradation scheme, where good companies didn't borrow money, but the bad companies borrowed money and siphoned it off. The entire textile upgradation scheme didn't deliver as much benefit as the money was spent. But in PLI scheme, there are checks and balances based on that experience, which is exciting investors to come over here. Now, iPhone 11, iPhone 12, they are being made in India. So this whole thing is shift of India from just being back office to the world courtesy or IT companies to becoming manufacturer to the world in certain segments, electronics, electricals, automobiles, and eventually into many more. So this is again creating a base for superior growth in the days to come. But ultimately, market is all about money. In June quarter ending, the profit of Nifty 50 companies came at roughly about 69,000 crore. September quarter expectation was 70,000 crore, 80,000 crore, was most positive 85,000 crore. When the numbers started rolling in, it came at 1,07,000 crore. It is the highest ever quarterly profit in the history of Nifty 50. And more importantly, this came when there was 7% degrowth in sales. Now, Subbu, when sales go down, you don't increase profitability, you lose profitability. With 7% drop in sales, Nifty 50 companies delivered 17% profit growth. Now, the bears or people who are standing, they are saying that, Naini, this is a one-time event. You cut salaries, you cut travel expenditure, you cut people's tea and coffee expenditure, which is why you made money. Now, going forward, that won't happen. The bulls are saying that, look, when sales was degrowing at 7% and we delivered 17% profit growth, imagine what will happen when sales will grow at 7%. What will be our profit growth? So fundamentals have improved so much in September quarter, and if it gets maintained, then certainly these markets are not going to correct.
Got it. That's very helpful, Nilesh. Now, the third part, which is Amar Akbar Anthony, which is the third part, which is the sentiments part, right? So clearly sentiments have improved, thanks to some of the factors that you mentioned. So two questions on that. One is a lot of heavy lifting of the growth index has been done by a few companies. So one of the questions that's been raised is, hey, if index is going to grow on the back of 4 or 5 companies, might as well go into those companies and stay invested for a long time. Why do I need a diversified portfolio? That's one question. The second related question to the sentiment, Nilesh, is about earnings catch up, right? I mean, one of the common words that we hear these days, not just in India, even in the US. In fact, it's a lot more heard in the US than in India, which is dislocation. People keep saying, hey, markets are dislocated compared to earnings. So how do you tie in sentiments with these two, questions?
So one, in market, there are people who have experienced 2008 correction, 2016 correction, 2013 correction. So when 2020 correction came, they actually pumped money into the market. They didn't withdraw. So their sentiment was impacted when markets corrected, but they didn't allow that sentiment to cloud their rational decision making. And those guys have done extremely well. The second set of people are retail investors who saw this correction as an opportunity to enter as their savings had gone up. Now, for example, if you are a salaried employee, suddenly your expenditure came down if your salary continued because you are no longer spending on traveling, entertainment, hotel, food, and so on and so forth. Now, this increased savings was deployed into stock market and stock market exploded. So they have made a lot of money. Their sentiment is very bullish. If earlier they experimented with 10,000 rupee, now they are willing to experiment with 1 lakh rupee because they are making money. The third thing is sentiment of foreigners, which I talked about. Compared to Wuhan virus vaccine manufacturer, their sentiments are positive. So put all these things together, retail investors who are making money, they are having positive sentiments. FPIs are positive because of perception change as well as the future potential based on the work which is being done by government. And that combination is resulting into this markets to continue. My feeling is that if we look at sentiment wise, FPIs, retail, HNIs, and domestic investors like mutual fund insurance companies, they'll all be positively looking towards 2021 as this vaccine development starts getting executed on ground.
Got it. So that was my last question on the markets and valuation list. When we look at 2021, this is like 17th of December we are speaking. So when we look at 2021 on each of these three things, foreign inflows, domestic indicators getting better, and sentiments. So what should we look forward to in 2021 on each of these three?
So there are three things which we'll have to look forward. One is this vaccination helping us to normalize. We should not face second wave of infection like Europe or US, which again creates need for a lockdown which will hamper economic activity. The second thing is related to month on month improvement. It's not that markets are cheap, markets are optimistic. It's like, the last 5 overs in T20, you have Rohit Sharma and Virat Kohli betting. The asking rate is high, it's in double digit. But both these guys are so capable and their eyes are so well placed and they are able to hit balls for a 4 and a 6 as per their will. But that doesn't mean that they have won the match. They still have 5 overs to go where they have to still hit 4s and 6s. So our month on month improvement over and over run rate is very, very critical. The third thing which you'll have to see, and this is more as an individual, is the quality. Today, you could be swayed by the momentum. And recently, Burger King IPO came. It has given fantastic return since listing. Now, when this kind of momentum gets built, you need to just take one step back and figure out why you are investing in this company. What is the valuation of this company? Does it make sense to buy at this point of time? Am I buying it for fundamentals? Am I buying it because prices have run up? If you are buying because prices have run up and are likely to run up, then please enter with a stop loss. It's your trading position. But if you are buying because you believe in that company's fundamental, then you need to check the valuation, you need to check your hypothesis and then invest. Don't do momentum investing in this kind of market, especially 2021.
Got it. Nilesh. That's very helpful. Now, switching to perspective of investors, retail investors at large, right? One of the questions people ask, look, both SIP investors as well as HNIs, people who are trying to invest in the market says, is this a good time to invest? Right? I mean, that's a very, very common question. I'm sure you hear from a lot of investor awareness program that you do. Is in these valuations, people form it in different ways. Are the valuations justified? Is it a good time to enter? All of this, right? While there is no one answer to this, I thought let me begin this segment of the customer perspective, the investor perspective, by asking the question: look, is this a good time to invest?
So many years ago, when I was a article clerk in a CA firm, and our next door neighbor was a broker, so I used to go and check with them: is this good time to invest in market? And he will tolerate me. But one day he got tired out of my regular questioning and turned around and said, Nilesh bhai, jeb mein paisa hai na, that is the best time to invest. You are coming and asking me every day, is this the time to invest? But you don't have any money to invest. In article clerk salary, you can barely run yourself. So please don't bother me. When you get money, you come back, I will tell you where to invest. So on a serious note, when you have money, that's the best time to invest. If you lose one day's interest, it can never be captured back. So you can't take laziness with your money. It needs to be invested the moment you receive it. Now, whether you invest in equity, debt, real estate, commodity, or offshore assets, that's a separate ball game. One can always make allocation in terms of underweight, overweight. One can make adjustment in terms of time horizon. But when you get money, that is the best time to invest.
Yeah, that's interesting. You also talked about the cricket analogy. I think you've also given in the past about how Virat Kohli plays different matches. Test match he plays differently. T20 he plays differently. One day match he plays differently. So he adapts his batting style to the match he's playing. Right. I'll flip the question in a different way, Nilesh. Is it a good time to play Test cricket? Is it a time to play T20? Is it a time to play one day match? Like, what's the format of the game should someone play?
So if you are making investment on a trend, then play like a test match. I'll give you a very small example. All of us grew up watching movies in a dabba theater. They were cheap, but there was no experience. And then, multiplex came. Now, by and large in Indian cities, the entertainment is movie watching. There are not much public playgrounds. There are not much, uncrowded places. So effectively, we all knew when the first multiplex came that this is the future of movie watching and it will take off big time. Now you are playing for multiplexes, then you don't play for 1 year, 2 year, 3 year. You are playing for 10 year, 20 year, 30 year. Now today, you know, multiplexes already pass. What could be such a long-term trend? Now let's look at a chemical business. It's like IT industry in 2000. In 2000 there was Y2K. So for converting those zeros into year 2000, we got money. Based on those relationships, our entrepreneurs did such a good work that they got more business, and slowly India's IT train started running. Same thing is happening in chemicals. People are buying from China, now they are coming to India. Companies are getting multi-million dollar contracts. There are companies which are buying $1 billion worth of chemicals from India, albeit from different companies. Now, can India, which is now about 4% market share in global chemical markets, slowly move towards 25-30%? China was at 43%, now they are about 37-38%. we may not reach 37, 38% level, but can we reach 25, 30%? If yes, then chemical is a 10-year, 15-year, 20-year play. It's not a 1-year play. Play like a test match. Now, on the other hand, let's say you want to play a momentum in an IPO. You know, this company is fundamentally not so good, but there is craze about it. Now, you are playing momentum play like a 1 day. In investment, you have to average when prices fall. In trading, you have to sell when prices fall. But in both investments and trading, you have to let your profits run. Many times what happens that people, they buy HDFC Bank in IPO, they know it's a great bank, but moment the stock doubled, they encashed it out. This was like playing T20 when you were supposed to play test match. On the other hand, I can 100% tell you that every single investor in his life, at least once, would have bought a stock, prices would have fallen, and he will convert this into investment, saying that when this price goes above my cost, then only I will sell. He will wait for 25, 30 years for that stock to perform, and eventually company will get delisted. So ensure that you know what you are playing. If it's trading, it's like T20 with stop loss. When prices fall, you cut your losses. In investment, it is like test cricket. When prices fall, fundamentals don't deteriorate. You average and you buy more.
Got it. So today, under what conditions, if I was a retail investor, Nilesh, under what conditions should I book my profits, and under what conditions should I continue? How should I think about think of someone as me as someone who's been doing a 5 to 10,000 rupees SIP for the last 5 years. So thankfully, I see positive returns now, unlike 6 months or 8 months ago. And I open Times of India, it says Sensex hits lifetime high. And there's a lurking fear in my mind that, hey, listen, look, now it's hit lifetime high, next is going to fall. So there's that fear that I might lose the profits that I have booked. But at the same time, I still have money. It's not that I'm short of funds. I can keep putting this 5 to 10,000 rupees every month. What's the decision framework for me to either book profits or to continue staying invested?
So you have to always make investment with a purpose. Am I investing for my house purchase, car purchase, my daughter's education, my son's wedding, my retirement, or for charity? Whatever be the case, you have defined your objectives. Against those objectives, you have particular asset allocation. Now, let's say there is a gentleman who had invested for purchasing a car. Now, markets are up. There are good offers available for car in the market, and you want to buy a car, please redeem and buy it. Second, let's say there is someone who is investing for retirement, and theoretically just assume that he put his entire money in equity in the month of March. Now wealth has expanded a lot and he still has a long-term horizon, but he does not have risk appetite to put 100% in equity. It was just by stroke of luck that he put everything on March, but now he won't be comfortable. So for that guy to take some profit out and bring that 100% to 70-30 or 60-40 or 50-50 is perfectly acceptable. Now, because you have long-term horizon, don't do it immediately. Do it slowly, slowly, slowly over a month's time so that you are able to average yourself. So you should redeem in line with your purpose. When markets go down and you become underweight equity, it is time to buy. Sell fixed income, buy this. When markets go up and your equity has gone way above your need, please sell equity, book profit and put it into fixed income. So one cycle happens based on your asset allocation. Second cycle happens based on your investment objective.
So Nilesh, I think that's a good segue. One of the things you've consistently said about retail investors is you simplified it in a very simple framework. You've said three things you need to keep in mind. One is invest regularly. Second, invest according to your goals, and third, invest according to your risk profile. I mean, it's a very simplified framework for retail investors. So my question to you is, do you see that happening in the market? And if we have to change this behavior where instead of people seeking just an extra return in a short period of time and they actually have to have a long-term orientation, what do we need to do as advisors, intermediaries, mutual fund companies like yourself? What can we do to move the customers to thinking in this framework? Regular investments, this according to the goals and according to the risk profile. Are you seeing that happening enough in real world?
So India is a very heterogeneous market. All kinds of varieties available over here. So I have seen investors who are extremely disciplined. They follow to the T their investment advisors advise, and they do asset allocation quite nicely. I have one IFA friend who shifts his clients from 100% debt to 100% equity whenever he feels appropriate. Now, this is extremely high conviction call, and touch wood, he has ensured that it works out every time. Now, does it happen that he's always timing it to the perfection? Answer is no. He redeemed equity in September 2017. Market went on to rise up till March 18. But after that, when markets corrected, he was smart enough to bring all this money by somewhere around July, August 2019. In the month of March, people suffered, but today they are back to profit. So this kind of extreme asset allocation also I have seen. I have seen more disciplined asset allocation also where people follow this. On the other hand, we have seen do-it-yourself customer also. They come looking at the momentum. So there was a time when one of our global emerging market fund had done exceptionally well. That was partly because of rupee depreciation and partly because of emerging markets doing well. And we suddenly started receiving flows in that fund. And similarly, when that fund underperformed, the same flows got redeemed. So there were sets of investors who were only coming from momentum. They had no idea what this underlying fund was, where the return came from. They came looking at the return, they went out looking at the return. Now, in this strategy, you are bound to make mistakes, you are less likely to make money. With investors, I will only give one advice: buy quality and go to sleep. While regular investment, asset allocation, and goal-based investment is important, your underlying theme is to buy quality and go to sleep. If you buy quality, no matter at what price, over a period of time, your holding period will ensure that it starts giving return to you.
Got it. So when you 2021, again from a retail average customer's perspective, what are the sectors that we should all watch out for? In light of the post-pandemic periods where vaccines will be out and hopefully everything will be, all of us will be out on the streets, traveling to our offices. Any key sectors that we should all keep a watch out, for any special things, Nilesh?
So one sector which is likely to do very well, I will call it home improvement, or in Indian context, building materials. Subbu, all of us have stayed at home. There is more wear and tear on home. Somewhere fans are not working, somewhere lights are not working, somewhere, paints have come out. And unlike in US where you do it yourself, furniture, fixture, fittings in your house, here we have to call outsider. In this 9 months lockdown or COVID-19 era, we have not dared to call someone. I haven't even called AC mechanic to clean my AC. But as vaccination happens, we will open up, and the first thing we will do will be home improvement. भाई fan replace कर दो, lights replace कर दो, paint कर दो, tiles बना दो, whatever it might be. Now, this pent-up demand on home improvement will create great opportunity in 2021 for building material sectors. Pipes, fittings, electricals, paints, cement, whatever the case may be. Anyone who is associated with this building material trend of home improvement, that sector is likely to do well.
Thanks, Nilesh, for that. One more question from an investor's perspective, right? Retail investor's perspective. One of the mistakes or the common mistakes that investors do is to choose a fund, and this is more common in DIY than in advisor-led or intermediary-led situations. But with more and more internet proliferating, we have lots of DIY customers, right? the key decision to choose a fund is typically based on historical returns. No matter how big and wide you put a disclaimer that look, the past performance is not an indication of future performance, but the selection criteria is significantly skewed towards past performance. And these investors are not financially savvy. They don't they can't see through the whole thing. For those type of investors, and generally for broader investors, how should one think about not focusing too much on the past performance and looking into the future? What kind of tools should they look for to identify, hey, listen, yeah, this is past, but the future could be dramatically different because of a variety of reasons. So any 2-3 tips for users to think of a framework to not get carried away by past returns?
So one, if you have disease, you don't go to chemist and say, give me some medicine. I have fever, मेरे को थोड़ी medicine दे दो. You still go to a doctor. Same way, mutual funds are like the chemist shops. I have all kinds of products available. But which product is good for you, that only a doctor can say. So you need to have an advisor who can give you what is good for you. When a doctor gives medicine, he doesn't say that you will get cured immediately. It will take time. Same way, when advisor gives you advice, it doesn't mean that you will make money immediately. It will take its own time. So having an advisor, having a distributor who can handhold you through variety of products, through volatility of market is extremely important. Never underestimate it. All of us have family doctor at our home. We always go to him whenever there is a problem. It is as important to have a family wealth advisor or family distributor who will plan about your wealth, who will plan about your future. The second thing is that, there is no shortcut to success. Money, if it was made as instantly as people are claiming, then everyone would have been billionaire. In fact, many of my cousin brothers think that, you give so much knowledge to everyone, so you must be knowing about everything. So you just tell me which script is going to go up tomorrow. I will buy it today and then sell it tomorrow. So I will make money every day. Now I have to really take pain to explain them ki bhaiya mere, if I knew what was going to happen tomorrow, why will I work? I will only trade because I don't know that I'm working. So you really have to be very, very careful about making money. Most people end up losing money because they don't take money management seriously. They want to go by a tip. They want to go by some miracle which says that your money will double in few days. This is a very, very hard way of doing things. Uh, this is more likely to result into losses than profit. Making money is all about common sense and discipline. Be a regular investor. Diversify your wealth into debt, equity, real estate, offshore assets, commodity, and be a long-term investor. If this three thing is done, I'm sure you will make money.
One question on the last point you made about the diversification. So you mentioned commodities, but one of the things that you probably included in that is gold. So one of the key questions that investors have in mind is about gold exposure. Like, should they invest in gold? What percentage should they have? Of course, it depends on individual customer. But I thought I'll take this opportunity to ask you about how should investors think about having a certain exposure to gold as an asset class within their broader investment portfolio when you look at 2021.
So in 2021, I think gold will do well. It had crossed $2,000 briefly. It has now come down to $1,850. At this or little below levels, gold is a good investment. We believe gold prices will continue to rise as liquidity is extremely high all over the world. Interest rates are extremely low, and people wouldn't mind shifting some amount of money from bank deposits where they are not earning anything to an asset like gold. When you're investing in gold, you need to be careful. One, in India, there is 12.5% import duty. So what gold is worth $100 in Dubai, when you buy it in India, you buy it at 112.50. God forbid if tomorrow import duty comes down to zero, then in one single day you will lose 12.5% of value of gold. So be aware that there is this potential risk, but subject to that risk, one should invest into gold.
Yeah, that's a very helpful thought, Nilesh. So I want to switch to some of the, some of the initiatives that Kotak has taken, some of the specific funds that you launched. The first, I'll take up the ESG fund that you launched, and it was a very, very successful NFO. Congratulations on that. But I want to ask from the users, our investors' perspective, what is special about ESG? Why is this category being talked about? Should people invest because this is something like a good Samaritan? We should all invest. Should we expect returns? You mentioned Prime Minister Modi also spoke about this in an investor conference. So I would, please throw some light on this category of ESG fund, because you had a successful fund. There are other NFOs also that came in the market or that have come in the last few months. So the general confusion about this.
So ESG fund is like lighting a candle in the dark night. By lighting candle, you not dispel the darkness, but at least whatever small area you have lighted, there the darkness is gone. Now, what is ESG? It is essentially a movement where you want to live better tomorrow for your kids and than what it is today. That is the whole objective, that we live better earth for our next generation than what we have got. How do we achieve that? So one is on the environmental side, we are not experts, we are learners, but we have joined hands with United Nations Principle of Responsible Investment, which teaches us what questions we have to ask, how do we have to monitor, and it is forcing companies to take corrective action on environment so that they are not polluting the world. It's not that with one candle entire darkness will disappear, but if all of us starts lighting candle like on a Diwali day, even Amavasya becomes full of light. The second thing is on social side. Now clearly there are so many issues which we are not aware of. As a male, I have very limited idea about what kind of injustice is done to female in jobs, in harassment on variety of things. We have no idea what they suffer. But if there is a set of questions which is being asked to me as an owner, then I will become aware about it. So social is all about improving social structure and community around you. And finally, governance. Governance will help you get better valuation, and hence you will make more money in better governance companies. Combination of this environmental, social and governance aspect will hopefully create better tomorrow than what we have today. So this is a very, very small effort by fund management community to improve our future. When it started, it was extremely small. Today now more than 3,000 fund managers have joined. They manage close to $100 trillion, and they have practically cut off money supply to some of the industries. Like there were companies which were making cluster bombs. Now that's been completely banned. Of course, this has more happened with United Nations banning it, but fund managers taking money out of that industry also had a role to play. So ESG investment is a small effort from our side to ensure that we live better tomorrow.
That's helpful. So one category which I wanted to ask earlier, I forgot, is overseas exposure. I mean, what's your view? How should investors think about having a certain asset allocation towards global stocks? In various ways. Any thoughts, any tips for our customers to think about how should they think of overseas exposure?
So I'll give you first my own personal experience with overseas investment. Many years back, I had a friend in US, extremely smart hedge fund manager. One day he called me saying that Nilesh, you should be investing in Zimbabwe market. And I said, well, Zimbabwe to country ekdam fate haal hai. Why should I drop money over there? And he gave me nice explanation about what their GDP was and what their market cap was and so on and so forth. And I trusted him and put some money over there. I lost 100% of my money over next couple of quarters. So overseas investment, when you're investing, you need to be very well aware that things can go wrong. Uh, so how do you manage that risk? So effectively, I will say US is as good as a continent. So if you're investing in US specific companies, great, no problem. But if you're going to invest into, let's say, Brazil or Russia or China or Zimbabwe, that kind of exotic markets, you try to be on a diversified basis. Don't put all your eggs in one basket. Invest in a global fund which will be allocating between Brazil, America, China, Russia, Turkey, Mexico, Israel, wherever it wants to invest. Second, instead of putting all your money in one fund, try to create as many funds as possible. It will dilute your return, but it will also dilute your risk. So instead of putting 100% of money in one overseas fund, try to put it into multiple overseas funds, some equity, some real estate, some commodity, and each one will deliver return to you when its cycle comes. Third, when you're investing in global funds, try to look at rupee. Now, our rupee is very peculiar. On a long-term basis, it keeps on depreciating, but the swings are quite different every year. There are periods when rupee appreciates, and then there are periods where it depreciates to cover it back. So in an appreciating rupee environment, you will lose money in offshore asset. But in a depreciating environment, you will make money. So if you can follow these principles, try to invest when rupee is in depreciating mode. Try to invest in multiple asset classes within global funds. And bearing US, try to remain as diversified as possible. Then offshore investments will start yielding good returns to you.
Yeah, and I think that's a good segue to the one of the NFOs that I think Kotak is having on this whole REIT concept, fund
Yeah,
of fund. New concept, Nilesh. I don't think we have too many real estate exposures in the Indian market for retail investors. Would love to know more about this. Like, who is it for? Like, who should think of investing? What can be the investment objective? Anything you could share that would be very helpful for our listeners.
sure. So we are coming out with Kotak Reit Fund NFO, which primarily invests into a Cayman Island REIT fund called SMM REIT Fund. SMM is Japanese asset management company, fairly good name, good set of people, professional fund managers. They, from that fund, invest money into various markets like Singapore, Hong Kong, Australia. They invest into various asset classes like commercial offices which are given on rent, residential premises which are given on rent. They also give data centers buildings on rent. They also give warehouses on rent. They give car park on rent. So they have a diversified portfolio in commercial, residential, car park, uh, warehouses, data center, logistics. In India, we normally get only commercial enterprises rental business. Over here, you are getting a diversified business. Plus, it is diversified in Singapore, Hong Kong, Australia, and other countries. So, effectively, it gives a fantastic portfolio on a diversified basis across countries, across businesses, which delivers you return. In REIT fund, return comes in three parts. One is the rental yield. In this fund, about rental yield is coming at 4.3%. The second is capital appreciation of underlying properties. As the value of commercial building, residential building rises, automatically your return goes up. And third will be depreciation of rupee if it happens. So if rupee moves down from 73 to 78, then to that extent fund benefits. So any investor who wants to invest in offshore assets and who wants fixed income plus kind of return and equity minus kind of volatility, this is the fund. This is somewhere between debt and equity.
Understood. And the returns for the customer investors, one is the appreciation. I'm assuming, is there a dividend component also in this? Because you said rental yield. So will that flow into investors in the form of dividends?
So uh, underlying REITs will remit dividend to SMEM. SMEM will pass it on to us, but we will be looking to redeploy that money rather than distribute by way of dividend because of taxation. In
Yeah.
India, dividend gets taxed as per your individual tax income. But on capital gain basis, it falls substantially below. And since we believe Kotak REIT NFO will be more towards middle income and HNI group, it is far better to allow them capital gains rather than dividend, which will be taxed at a higher rate.
No, that's one question because of the taxation for dividends. I think that's I wanted to get clarity on that. Thank you so much. Uh, one last question from the investors' perspective, then I'll end the section, conversation with one final question. So, one of the new things that's happening, Nilesh, is from the investors' perspective, is there is a variety of new funds being launched. Index funds, fund of funds, ETFs, and there are newer actively managed funds like ESG. All of these coming in. So passive investing is something that investors are beginning to hear in the form of ETFs and fund of fund. Again, from a retail investor's perspective, I wanted to request you. Can you suggest a framework? How should people think about these newer? These are not really newer asset classes. These are essentially funds, but a newer type of funds, but people haven't heard of. So how should I think about, should I invest in an ETF or a fund of fund or any index-based fund?
So essentially, buying mutual fund in some sense is linked to like eating at restaurants. If you are in a hurry, you will just go and get the thali. That's good enough. But if there is a special occasion, then you will go for a Chinese food or a Punjabi food or a South Indian food or whatever it is. If someone says Moroccan food is good, you will first go and experiment. You will take few dishes, get experience, okay, it is good. Then you will bring your family over there. On the other end, if you are hurry, you will take street food, vada pav, sandwich, and move on. So, people pick up different kind of food based on their own understanding, based on their own experience, based on reference from someone, or based on going to Zomato kind of site which will give you ranking. The same thing is applicable in mutual fund. For bulk of your need, diversified funds are suitable. Then there are exotic funds which are available for special occasions. If you are in a hurry, then there are index funds which are also available. Essentially, you have to create a portfolio between index funds, diversified funds, sectoral funds, offshore funds, which will eventually help you outperform inflation. Don't expect miracle from your advisor. He is not God. He cannot save you if markets give negative return. Only thing he can try is that your negative returns will be lower than the market return. That's his contribution. So have a good advisor, build up a portfolio between passive funds, active funds, index funds, ETFs, diversified funds, sectoral funds. If you have about 15-20 mutual funds in your script across these different themes, that should be broadly good enough to meet your investment requirements.
That's very helpful, Nilesh. I think I would let you offer a final comment of advice to all our listeners. But this has been a very, very helpful discussion. So, any final comments from you for average investor who is looking at all this complex, things that are going on in the markets today?
So I will end with a very, very simple experience. Uh, Investment is all about common sense, and it is far more simpler than you think. Let me give you an example of Peter Lynch, who was a legendary fund manager of Fidelity Magellan. In his days, it was the largest equity fund in the world. He had a team of fund managers assisting him. And obviously, all fund managers like us are very egoistic person. So to bring his boys onto the ground, he took them to a school and said that these kids will build a portfolio and you have to outperform them by building your portfolio. The fund manager said, "Ki boss, matlab ye kya hai? Give us a worthy competition. How can I compete with this kid?" And Peter Lynch was very serious. He said, "No, you have to compete with this kid, and I'm very serious about it. If you underperform, you will lose your job, you will lose your bonus." All the fund managers opened up their reams of data, computers, and figured out most highest risk, highest return stocks because they had to win over the kids. The kids were all in jolly mood. They had no worry about fund managers. They didn't even believe they were in a competition. So they picked up stocks which they knew about. Eventually, kids picked up stocks whose product they were using. Someone was liking Cadbury, he picked up Cadbury. Someone went for toy shopping, he picked up Toys R Us. Someone went for cereals, he picked up cereal companies. Someone was using baby oil product, he picked up baby oil product. Essentially, they picked up products of companies which they were using. 1 year down the line, Peter Lynch showed the results. Kids had outperformed professional fund managers by a big margin. Where did fund managers went wrong? They were under pressure, so they went for high risk, high return battle. Kids were under no pressure. They went for low risk but low return product. In the world of investments, if you don't lose money, that itself is a winning. People make 30% return in 3 years. Next year they lose 50%. That straight away takes away a lot of your return. So in making money in investments, just remember two rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1.
Thank you, Nilesh. That was very, very nicely put. Hello, everyone. I think this was a wonderful session by Nilesh. Thanks, Nilesh, for joining us, and thank you, everyone, for joining us on the show. Have a good evening. Thank you so much.
Bye.
Bye.